Welcome to the Deep Dive, your way to get instantly up to speed. Today, we're really tearing into the Q3 2025 results for Cheniere Energy, the big U.S. LNG player. These dropped October 30th. And it's a fascinating picture, isn't it? There's this kind of paradox right at the top.
Yeah, absolutely. A real headline split. Management's calling it another outstanding quarter. But you look at the top line and you might scratch your head a bit.
Right, because the market reaction was, well, pretty flat overall.
Exactly, which tells you, it tells you investors were focused elsewhere, not on that revenue number.
Okay, let's get those headlines out then. So the GAAP EPS, earnings per share, was $4.75. That absolutely crushed the consensus, which was what, somewhere between $2.75 and $2.95?
Yeah, a huge beat on the bottom line, no question. But then revenue, $4.44 billion.
And the street was looking for closer to $4.88 billion. So that's nearly a $400 million miss.
A $400 million miss. Usually you'd expect the stock to take a hit on that, but nope, flat.
So clearly, investors were already digging deeper, looking past that revenue figure.
They were looking at cash generation efficiency, and maybe even more importantly, how fast they're getting future capacity built. That's the real story here.
Right, let's unpack that cash generation then. The core business looks solid enough, right? Net income was $1.05 billion.
Yep, and consolidated adjusted EBITDA, that came in at $1.61 billion, which is up 8% year over year. So the engine's running well.
But the big news, the thing that really moved the needle internally, was the distributable cash flow.
That's it. That's the key metric. It's the cash management can actually, distribute back to shareholders or plow back into the business. And they lifted the guidance for FY25 DCF significantly. It was $4.4 to $4.8 billion.
And now?
Now it's $4.8 to $5.2 billion. That's a $400 million increase at the midpoint. Massive bump.
Wow. Okay. A $400 million jump in cash flow they expect to have available. Did they suddenly sell a bunch more LNG or get way better prices?
No, and that's the really interesting part. This wasn't about core operations suddenly improving by that much. It was basically a policy-driven thing, a discrete event.
Policy-driven.
Yeah. The IRS revised some rules around the corporate alternative minimum tax, or CAMT.
Okay, hang on. CAMT. For listeners maybe not steeped in tax code, what is that, quickly?
Right, good point. So the CMT is basically designed to make sure large, profitable companies pay at least a minimum amount of tax, like 15%, even if they have lots of deductions. But the rule change here actually lets Cheniere defer certain cash taxes. And, get this, it even means they're entitled to a refund of some CAMT they'd already paid.
Okay. So it's not that the underlying business is suddenly making $400 million more profit operationally.
Exactly.
It's more like an accounting and timing benefit that frees up cash now. Pure cash, basically risk-free, landing on their balance sheet sooner.
That's a great way to put it. It gives them a huge boost in near-term financial flexibility. It's a big psychological win for investors, too, seeing that cash certainty increase.
And they made sure to stress the core business is still on track.
Oh, yeah. They firmly reaffirmed the full year 2025 guidance for consolidated adjusted EBITDA, still $6.6 billion to $7.0 billion. So the message is clear. The main engine is performing just fine. This tax thing is just extra financial firepower.
Got it. Okay, so financials are strong, maybe even stronger than expected because of that tax tweak. Let's pivot to the growth story then. Corpus Christi Stage 3. CCL Stage 3. That seems to be where the operational excitement is.
Oh, absolutely. Acceleration is the key word there. They said the total project is already over 90% complete.
Over 90%. That's moving fast.
And the real eye-opener was Train 3. It hit substantial completion back in October.
Right, and I saw the stat on the ramp-up time. That was pretty incredible.
Wasn't it? Only 38 days from making the first drop of LNG to reaching substantial completion. Just 38 days.
And compared to Train 1?
Train 1 took 77 days, so they've basically cut that critical debugging and optimization phase almost in half.
That's serious efficiency game. Shows they're learning fast.
It really does. It's proof of rapid knowledge transfer. When you're spending billions shaving weeks off that ramp up, that de-risks things massively. It means cash flows start sooner.
And that speed lets them pull forward the timeline for the next trains too, right? Train 4.
Yep. Train 4 should produce its first LNG very soon, they said. And it's still on track for substantial completion by the end of this year, 2025.
And then Trains 5, 6, and 7.
They're lined up pretty quick after that, scheduled for spring, summer, and fall of 2026, respectively, all coming online next year.
So this confidence, this acceleration, feeds directly into their early look at 2026 production.
Exactly. They put out a preliminary forecast for 2026, 51 to 53 million tons of LNG.
51 to 53 million tons. That's a huge number. That would make 2026 a record year. Easily, like a 5 million ton jump year over year.
It's a big step up. But, it's important to mention they're achieving this even while dealing with some increasing operational challenges.
Oh, like what?
Well, the feed gas they're getting, especially from the Permian Basin, its composition is getting more variable.
More variable how?
Higher amounts of what they call heavies, basically a longer chain hydrocarbons, C12 plus stuff, and also more nitrogen.
Okay, heavies, C12 plus fade. What does that actually do to an LNG plant? Does it damage the equipment?
It doesn't necessarily damage it outright if managed, but it makes operations trickier. Think of the plant as a giant super cold refrigerator. These heavier molecules, they freeze or condense at higher temperatures than methane, so they can kind of gum up the works, cause fouling in the heat exchangers. It means the operators have to be constantly adjusting.
Adjusting how?
Things like running more frequent defrost cycles, injecting solvents to clean things out, or sometimes operating in what's called wet mode during the chilling process. It requires, real-time finesse. It's definitely extra wear and tear potential.
So it's like the raw material they're working with is changing and they have to constantly adapt their process. A new reality, basically.
It seems that way. And the key thing management stressed is that their strong 2026 forecast already includes time for strategically planned maintenance to deal with this. They're building in resiliency.
Proactive maintenance baked in. Okay.
And on the commercial side, just to round that out, they also locked in a new long-term deal with JERA. 1 million tons per year, Henry Hub indexed, running all the way out from 2029 to 2050, so adding even more contracted stability.
Right, so operations accelerating, production forecast looks huge for 26, even with those feed gas challenges, and cash position boosted by the tax change. Let's talk about how they're using that cash, capital allocation. Sounds like they opened the fire hose on buybacks in Q3.
They certainly did. They were very active, deployed about $1.8 billion under their overall capital plan just in Q3.
And a big chunk of that was share repurchase.
$1 billion of it, yeah. Bought back roughly 4.4 million shares. That's actually the second highest amount they've ever repurchased in a single quarter.
So they clearly saw the stock as undervalued during any volatility.
Seems that way. Management basically said they were taking advantage of perceived value, using the strong cash flow opportunistically.
And they bumped the dividend too, didn't they? Another signal of confidence.
Yep, raised it over 10%. It's now 0.5555 per share quarterly, which is $2.22 annualized. It definitely signals management's belief in the durability of these cash flows.
And they're still on track for that big multi-year capital return goal.
Comfortably. They expect to blow past the initial $20 billion target well before the end of 2026.
Okay, but looking further out, beyond CCL Stage 3, what about new projects like expanding Sabine Pass or maybe a CCL Stage 4? Everyone else seems to be racing to build. Are they jumping in?
That's where their message on discipline was really strong. They talked about sticking to the Cheniere standard for sanctioning any new capacity.
The Cheniere standard. Sounds strict.
It is. They're explicitly setting themselves apart from what they called LNG tourists and an undisciplined environment. They're not just going to build because they can.
So what are the hurdles? What did that standard actually require?
Okay, 3 key things. 1, growth has to be self-funded from their own cash flow. 2, projects need to show unlevered returns of 10%. And 3, this is crucial, the economics have to work even if gas margins are under $3 per MMBtu.
Under $3, but current prices are much higher, aren't they? Yeah. Like $5 on the forward curve.
Exactly. They're stress testing projects against much lower, more conservative long-term price assumptions, not today's higher spot-influenced prices. And the final piece is they need over 90% of the capacity contracted with investment-grade buyers before they commit capital.
Wow. Okay, so very high bar. Prioritizing balance sheet strength and return thresholds over just chasing volume.
That's the takeaway, discipline over speed, for new projects anyway.
Right. Okay, shifting gears a bit, let's look outside Cheniere at the global market. Where's all this LNG going? Who's buying?
Well, Europe is still the main demand sink right now. It's really pulling U.S. cargoes across the Atlantic.
Still replacing Russian gas?
Yeah, Russian pipeline flows were down something like 43% year over year. That leaves a huge gap. Plus, Europe came into the quarter needing to inject a lot into storage. They figured about a 130 LNG cargo deficit needed filling. So, strong pull from Europe.
But Asia seemed a bit softer. That's usually seen as the big long-term growth engine.
It was softer in Q3, yeah. Asian LNG imports were actually down about 4% year over year.
Why was that?
Kind of a mix of things. Milder weather played a role. China actually produced more of its own domestic gas, and spot prices were still pretty elevated, which dampens demand in some of those more price-sensitive Asian markets.
Okay, but Cheniere sees that changing.
They do. Their view is that as all this new global supply starts hitting the market over the next few years, that market tightness will ease. Prices should become less volatile, more stable.
And lower, more stable prices are actually good for long-term demand growth in Asia. Seems counterintuitive.
It sounds it, but yeah. The idea is that extreme price volatility makes it hard for countries like India, Pakistan, Thailand, places that need a lot more gas, to commit to building the expensive import terminals and pipelines they need. If prices settle down into a more predictable lower range, it gives them the confidence to make those long-term infrastructure investments and sign the long-term purchase agreements. It actually catalyzes demand in those key growth regions.
Makes sense. Predictability enables investment. And speaking of new supply, how much are we actually talking about globally?
It's a massive wave coming. The forecast is for an average of 35 million tons of new liquefaction capacity coming online each year from 2025 through 2030.
35 million tons a year for 5 or 6 years straight. That's huge.
Unprecedented, really. And that's what underpins their view on prices for next year, for 2026.
What's the forward curve saying for 2026 Asian spot prices?
It's pointing to the $11 range. Around $11 per MMBtu.
Okay, $11. Still profitable for U.S. LNG, but definitely a shift down.
Exactly. They called it a pivot towards more normalized spot prices. It signals the end of those, crisis level premiums we saw, but still a very healthy price globally that supports continued gas adoption.
Okay, so let's try to wrap this all up. Summing up the deep dive on Cheniere's Q3. The big financial beat wasn't really about selling more gas right now. It was the CAMT tax benefit boosting the DCF outlook.
Right, policy windfall.
But the operational story is all about acceleration. CCL Stage 3 is finishing faster, especially Train 3's quick ramp-up, which gives them massive confidence to predict record production in 2026.
Yep, operational execution shining through, even with those feed gas hurdles they're managing.
And they're taking that increased certainty from the tax cash and the faster production and plowing it aggressively into share buybacks and dividends.
Absolutely. Or turning capital, showing conviction in their own valuation while maintaining strict discipline on funding new growth. That's the narrative arc.
Which leads us nicely into our final segment.
This is not financial advice, TINF.
All right, so the setup here is really built on that theme of certainty we just discussed. You've got certainty from the tax change. That $400 million DCF boost is pretty much locked in.
Policy certainty.
And you've got certainty from execution, Trains 3 and 4 coming online faster, de-risking that huge 53 million ton production forecast for 2026. The cash flows are visible and arriving sooner.
Right, operational certainty. But the stock didn't really pop on the news, stayed pretty flat.
So you combine that known acceleration and cash boost with management's very clear actions, dropping $1 billion on buybacks in Q3 alone, aiming for $20 billion plus overall.
And you start to see a potential disconnect, right? Management seems to believe the market isn't fully appreciating how quickly and reliably that future cash flow is coming. They're effectively telling you they think the stock is cheap by buying so much of it.
Okay, so boil it down. The outrageous but plausible trade idea, harvesting acceleration and DCF certainty. What's the pitch?
The pitch is basically to sell near-term volatility, maybe using options. You're essentially betting that even if the broader energy market stays choppy or range-bound, Cheniere's own operational discipline and, more importantly, their massive ongoing buyback program will act as a strong floor under the stock price. Management keeps buying opportunistically, soaking up shares, while you collect the premium from selling volatility, wagering that the market will eventually have to catch up and price in that accelerated 2026 reality and the enhanced DCF. You're betting on the company's own capital allocation actions.
Interesting. Leveraging their confidence for your own trade. Okay, that's definitely food for thought.
Okay.
Now, for a final provocative thought for you, the listener, to chew on. We talked about Cheniere managing this challenge of variable Permian feed gas, the heavies, the nitrogen. It's a complex, non-weather operational issue.
Right. A chemical engineering challenge, really.
Right. So, thinking beyond that specific issue and beyond just building new plants.
Yeah.
What other long-term, non-weather operational variables, things that aren't just CapEx, do you think will be the defining risk or maybe opportunity for the reliability and performance of the entire U.S. LNG export sector over the next 5 years?
It's a critical question as the U.S. role grows, isn't it? Something to really ponder. Well, that's our deep dive for today. Thanks for joining us.
Until next time.